Do you know what the 5 richest technology companies in the world are collectively doing this year? They are all scrambling for the same batch of goods, the compute infrastructure for artificial intelligence. Amazon, Google, Microsoft, Meta, and Oracle. These five together have committed more than $660 billion in technology investment budgets for the year 2026. What does $660 billion represent? It is roughly on the same scale as the total new infrastructure investment added across all of China in a single year. The vast majority of this money is being spent on what chips, memory, optical fiber, power systems. In short, they are building one artificial intelligence, what a power plant after another. And many of the items on the shopping list are in a state where every unit purchased means one less available. They are in short supply everywhere. So the question we are addressing today is this. Where is all this money flowing? If we follow the supply chain downstream, which companies are the true beneficiaries, and which ones have already been overtyped by the market? I just attended a very interesting investment research discussion. A group of Wall Street analysts, each with more than a decade of experience, thoroughly dissected the entire artificial intelligence infrastructure sector. The debate was quite heated. I am now translating the core conclusions from their discussion for you first. Let us talk about what has actually changed in artificial intelligence. In the past, when people talked about artificial intelligence, they mainly meant training large models, using massive amounts of compute power and data to build the foundational intelligence of artificial intelligence. That phase consumed an enormous amount of money, but the commercial returns were unclear. It was a bit like constructing a factory without yet starting product, but things are different now. You can use Claude to help write your code, use artificial intelligence to process legal contracts, or have artificial intelligence draft an entire industry report for you. These are real usage cases, real payments, and real business value. Last year, OpenAI annual revenue exceeded $20 billion. 2 years earlier, that figure was close to zero. Anthropic and other artificial intelligence companies are also seeing their revenues take off rocket. Once artificial intelligence starts genuinely making money, the expansion of data centers is no longer a matter of faith, it becomes pure business logic. Consider this simple calculation. The annual cost of employing an artificial intelligence agent is roughly $20,000, while the full cost of hiring a white-collar employee with comparable capability exceeds $150,000. Any chief financial officer can do this math, and after doing it, they all want to buy more artificial intels. So why are these 5 major cloud providers boldly pouring in $660 billion? Because they have already seen the returns. Okay, the demand is real. So who is supplying the good? Let us start with the biggest name, NVIDIA. NVIDIA just released the strongest quarterly report in its history. Quarterly revenue reached $68.1 billion, up 73% year over year. The guidance for the next quarter is $78 billion, and the upward trend continues. But here is a very interesting phenomenon. After releasing such astonishing earnings, NVIDIA's stock price still fell by 5%. What does this mean? Let me explain. One of the most fiercely debated points among the analysts was NVIDIA entry timing question. One side argued NVIDIA moat is real. Its core moat is called CUDA, its software ecosystem. Tens of thousands of engineers and researchers around the world write code using NVIDIA and framework. Replacing this ecosystem would take 5 to 10 years. It is not something any company can do overnight. Moreover, the major hyperscale cloud providers have made it clear that their biggest problem is not whether to buy, but not being able to buy enough. It's our supply constrained, not demand constrained, the other side countered. A strong moat is one thing. Whether the current price represents a good entry point is an entirely separate question. Some pointed to an example from more than 20 years ago. At the peak of the internet bubble in the year 2000, Cisco was widely regarded as the undisputed king of internet infrastructure, and its stock price was bid up to the heavens. Then, Cisco stock fell by 80% and took more than 20 years to return to its previous high, not because the company deteriorated, but because the stock price had already priced in 20 years of good news in advance, leaving no further positive surprises to drive the valuation high. Today, NVIDIA is certainly far stronger than Cisco was back then, and the demand is much more solid. But the principle remains the same. Buying a great company at too expensive a price can still lead to losses. NVIDIA current price to earnings ratio is roughly between 35 and 40 times. In an environment where the Federal Reserve maintains high interest rates, there is very little room for this multiple to expand further. So what was the final conclusion of the debate? NVIDIA is a great company, but at the current price, investors need to wait for a better entry point. It is not appropriate to rush in at any time. A great company and a great stock are sometimes two different things. The key is the price at which you buy it. Are there any that are both great and reasonably priced? Yes. And this was the most surprising discovery for many people in the discussion. Micron technology. Micron produces memory chips, specifically the critically important high bandwidth memory that sits right next to artificial intelligence chips, known in the industry as HBA. How should we understand HBM? Imagine a top chef working in a kitchen. The GPU is the chef, and HBM is the fastest prep station right beside him, handing ingredients to his hand at maximum speed. Without a sufficiently fast prep station, even the most skilled chef would stand there waiting, and efficiency would be completely weighed. The stronger the GPU, the higher the requirements for both speed and capacity of HBM. NVIDIA latest bar goes, each require high-spec HBM to be paired with them. The two are sold in a bundled relation. The problem is that HBM is extremely difficult to manufacture. Globally, only 3 companies are capable of producing it: SK Hynix, Samsung, and Micron. And Micron just announced that its entire high-bandwidth memory production for the year 2026 has already been fully sold out in advance, not projected to sell out, but already contracted and sold out. Now look at the financials. Micron's latest guidance shows a quarterly gross margin of 68%, meaning for every $100 of goods sold, they keep $68 in gross profit. 2 years ago, that figure was only 27%. The profit margin has more than doubled in a half. Yet amazingly, Micron's price-to-earnings ratio is only between 6 and 10 times. Most technology stocks in the market trade at 20 to 30 times or higher. NVIDIA is close to 40 times, while Micron trades at just 6 to 10 times. It is like buying a red-hot, full-price item at half price during a sale, and this hot item is still in short supply. This is what the analysts call margin of safety, buying a company that is genuinely profitable and becoming increasingly profitable at a reasonable price. Micron is currently the only core player in the entire artificial intelligence infrastructure sector that simultaneously satisfies both strong fundamentals and reasonable valuation. This was the most important conclusion of the entire discussion, continuing deeper down the artificial intelligence supply chain. Beyond BIOS and memory, another bottleneck that has received far less attention is quietly emerging: optical modules. Imagine an ultra-large artificial intelligence data center with tens of thousands of bogs working simultaneously. These gargos do not operate independently. They need to transfer data to each other at very high speeds. The larger the scale, the greater the transmission demand. NVIDIA in latest architecture is called NVIDIA 576. A single rack stuffed with 576 GPUs connecting these chips with copper cables would cause severe signal attenuation and absurdly high power consumption. It is physically impossible, so there is only one path: optical fiber connections, converting electrical signals into optical signals for transmission. That is exactly what optical modules do. 800 gigabit optical modules, 1.6 terabit optical modules. This is not an optional upgrade. It is an inevitable step dictated by the laws of physics. On March 2, 2026, NVIDIA CEO Jensen Huang made a move. He simultaneously invested $2 billion in each of 2 optical module companies for a total of $4 billion and signed strategic cooperation and supply agreements. Those 2 companies are Lumentum and Coherent. Jensen Huang is not someone who casually spends $4 billion. This move essentially signals optical modules are the next critical bottleneck in artificial intelligence infrastructure, and I want to lock them up in advance, but the analysts here made an important layered jut. Lumentum has already risen by approximately 250% this year. Most of the good news has already been priced in. Chasing it at this point offers very poor risk-reward. Coherent, by comparison, has a more reasonable valuation. NVIDIA investment has clearly endorsed its strategic position, yet market sentiment has not fully caught up. So if choosing within the optical module space, Coherent offers the better entry point in terms of value. As for another optical module company, Applied Optoelectronics, also known as AAOI, its stock has risen about 173% year to date, supported by real fundamentals. Its revenue guidance for 2026 exceeds $1 billion. However, its financial quality and depth of moat are not on the same level as Micron or Coherent. The analysts' consensus is that this is a high risk, high reward opportunity, not a core position suitable for heavy allocation. Taking a step back to a broader picture, there is one beneficiary chain that most people have not considered. Artificial intelligence data centers are currently the fastest growing consumers of electricity in the world. NVIDIA's latest rack consumes as much as 120 kilowatts. If a cloud provider deploys 1 million such racks this year, that is a total of 120 billion watts, roughly equivalent to 1/4 of all residential electricity consumption in China. And all of it is new domain, who supplies power, cooling, and power management to these data centers. 99% of the market attention is focused on GAGUs, but the companies that handle data center power management and liquid cooling are also enjoying an explosion of orders from artificial intelligence, and their valuations are far cheaper than GPU companies with far less market attention. Vertiv Holdings is one such company. It provides power solutions and liquid cooling systems for data centers. In its latest earnings report, artificial intelligence data center related orders grew by more than 60% year over year, yet it receives far less spotlight than NVIDIA. The places where the market spotlight shines least are often where the real bottlenecks hide, and bottlenecks are the source of pricing power. There was one extremely critical question raised in this discussion that I believe must be clarified because many people have misconceptions about it. Will cheaper artificial intelligence reduce the demand for artificial intelligence compute power? At the beginning of 2025, a Chinese company called DeepSeek released an artificial intelligence system that claimed extremely low cost, yet matched the performance of top-tier models. This suddenly triggered market panic. Does this mean demand for artificial intelligence chips will decline? NVIDIA's stock price dropped sharply in a single day as a result? This logic feels intuitively plausible, but in reality it works in the opposite direction. Let me give you an everyday example. Suppose highway tolls are suddenly reduced by 90%. Would fewer cars use the highway? Quite the opposite, it would cause traffic jams. Lower tolls mean more people choose to drive on the highway. More people using it means overall traffic volume increases dramatically. Artificial intelligence follows the same principle. When the cost of artificial intelligence inference drops by 10 times, all the application scenarios that were previously but too expensive to use suddenly become viable. Every mobile app wants to embed an artificial intelligence assistant. Every company wants to increment business prices with artificial intelligence unaffordable can now afford it. The newly unlocked demand far exceeds the savings from efficiency gains. This is not a hypothesis. It has already happened. After DeepSeek release, Amazon, Google, Microsoft, and Meta, in their earnings calls, not only did not reduce their capital expenditure plans for 2026, but actually raised them significantly. They were all saying the same thing. The cheaper artificial intelligence becomes the more people use it. The more people use it, the more money gets poured into building artificial intelligence. This is the deeper reason why this wave of artificial intelligence infrastructure investment is so persistent and so certain. Of course, I must also clearly state the risks here. Any good analysis has to confront the factors that could invalidate the logic. First, the suppression from high interest rates. The Federal Reserve and current interest rates remain elevated in a high interest rate environment. Growth stocks with expensive valuations are naturally pressured, not because the companies are getting worse, but because higher discount rates make future profits appear less valuable today. This is why even great companies sometimes need to wait for the right purchase price. Second, questions about the return on artificial intelligence investment. More and more voices are asking, these cloud providers are spending so much money. Where exactly is the artificial intelligence revenue? This doubt may not be correct, but if it spreads widely in the market, even if fundamentals remain unchanged, stock prices can still suffer temporary emotional sell-off. Third, geopolitical risk in the Taiwan Strait. More than 90% of the world's advanced process chips are produced by TSMC in Taiwan. Taiwan is only 130 kilometers from mainland China. This is the largest systemic tail risk in the artificial intelligence infrastructure supply chain. The probability is low, but if it materializes, it would not be a slowdown. It would halt the entire system. This is not a risk that can be reasoned away. It can only be approached with sufficient caution in possessing, fourth, intensifying competition in the high bandwidth memory field. SK Hynix currently holds the largest market share, and Samsung is catching up in the optical module industry. Moats have historically been thin. Every few years, a new speed standard emerges, bringing new competitors. These require ongoing monitoring rather than a one-time judgment and permanent holds of putting it all together. This discussion revealed a more macro frame. The beneficiary chain in artificial intelligence infrastructure has 4 layers. The top layer is GPU and compute, the most crowded and most expensive in valuation. The second layer is high bandwidth memory storage, supply constrained yet reasonably valued, currently offering the greatest margin of safety. The third layer is optical module transmission, the next bottleneck emerging, requiring careful selection. The bottom layer is power and manufacturing infrastructure, the least noticed, yet the most persistent in demand, and the most solid in mode. The deeper you go into foundational infrastructure, the more the market tends to undervalue it. Yet the wider the moat becomes. The biggest alpha does not lie in buying the hottest names, but in identifying the most certain infrastructure, bottlenecks. Finally, I want to leave you with one quest. What stage of the artificial intelligence revolution are we in right now? Think of it on this timeline. Between 1994 and 1999, internet infrastructure was expanding frantically, and the dot-com bubble was slowly inflating. But there's one key difference. Back then, most internet companies had not yet started making real money. Their business models were hypothetical. Today, artificial intelligence is already genuinely replacing human labor, genuinely generating revenue, and genuinely driving corporate spend. This time, artificial intelligence may be at the 1999 internet stage, but history always accelerates. Some companies have already started making real money. What does this difference mean? Precisely the kind of certain investment opportunities mentioned above. The above content represents personal thoughts only and is not investment advice. Thank you for your company.